Tax savings. This is Tony Novak here to share a few points on saving taxes and staying out of tax trouble. Today's topic is the additional dependent tax credit and why it often runs into trouble. So let's jump right in. So everyone knows, I think, that when you have children dependents, even parent dependents, you get to take a deduction for them, and for children, you can get a tax credit. Now, there is also, not so well known, an additional tax credit for a dependent who is not a child. It can be, there's no relationship requirement. In my case, I took care of a disabled friend for many years and handled all his paperwork, all of his finances, and he was an actual dependent for many years. So that's the type of person that would qualify. So there are a lot of people who do have take care of additional people, treat them like household members, and while they're not children, they are dependents. In addition, in this world, many of us parents my age know that there are children that become adult age, and yet for whatever reason they're not working, not supporting themselves, and we are supporting them as parents. So we may also be eligible for this tax credit, even though they're not dependent. They don't meet the age rules for dependents. They are still dependents and at least eligible for a $500 tax credit. Here's where that plan runs into trouble. In many cases, in most cases, most of us adults have to have health insurance. It's just too risky not to have health insurance. And we have a great national plan from the Affordable Care Act that allows low-income people who don't have enough money to afford health insurance to get it cheap. And the federal government provides a premium subsidy. Now, for a person that has almost no income or very low income, it's Medicaid. We're not talking about those people. That's not part of this discussion. They're okay. But the people who make a little bit of money and get their health insurance through the insurance exchange or the state provider plan, that premium is often subsidized by a federal tax credit. Now, here's the problem. When you take the dependent tax credit of $500, as soon as you put that dependent on your tax return, you also have to report their health insurance subsidy. You can't even file the tax return unless you report that information on your tax return. Now, it's logical to think that the person supporting the dependent has a higher income, so that the premium subsidy eligibility is recalculated based on the taxpayer, that is the higher income person's income. And so in that case, the entire premium can be owed back to the government and wipes out the benefit. Even though you're eligible for the $500, you wind up being also having that wiped out by a return of the premium tax credit. So I use a lot of words to describe that. And so let me just recap and say that while that $500 credit sounds good, don't touch it if the person's on health insurance from the Affordable Care Act. It usually doesn't work out. Would love to hear your thoughts or experiences or feedback on this. Or if you want to talk with me one-on-one, that's easy also. Find me at taxproblems.cpa and click that Let's Talk button. I'll be back tomorrow with another tax